If you are investing in 2023 and following the standard logic on how to structure a portfolio based on age and risk tolerance, honestly, you're probably leaving money on the table and you're probably taking on much more risk than required to generate the same percentage return that you are generating. So the goal for this video is to help you better understand the one thing that you should consider changing about your investment portfolio in 2023 to lower overall risk without really affecting the percentage return. If you are investing for your future, then this video is serious and should be taken seriously. Now, I want to do two things in this video. First, I want to go over how you should structure your portfolio on a usual normal year. This will be good if you're watching this video sometime after 2023, or if you're watching once the economic environment goes back to normal. After that, I want to go over the one simple main change that you can do to make your portfolio safer without really leaving percentage return on the table. Now, usually higher returns equals higher risk, but this year in particular, that is not necessarily the case. This is day 20 of 100 Days of Finance, where the entire goal is to give you more personal finance education in 100 days than most people receive in their entire lifetime. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's get right into the video. So the first of two things in this video, the standard way to structure your long-term investment portfolio based on age and risk tolerance. There are three main stages to standard average risk aversion portfolio structuring. The first stage is known as early career. This usually happens in your 20s and 30s, but it can also be seen as 40 to 50 years away from retirement. Because you are so far away from retirement, this is considered the time to take advantage of your long time horizon and take a higher risk approach. A typical allocation might be 80% stocks and 20% bonds, with of course a focus on low cost ETFs. Now, if you are more of a risk taker, you can take anywhere from 5 to 15% of that stock allocation and invest in individual stocks that you feel, based on evidence, will outperform the market. The second stage is known as mid-career. This is usually in your 40s and your 50s, but it can also be seen as 20 to 30 years away from retirement. And remember, the whole goal of investing is capital preservation first, then returns. People seem to forget that, and this only increases as you approach retirement. So because of this, you'll want to gradually start reducing your allocation to riskier assets like stocks, and start increasing your allocation to safer assets like bonds. A typical portfolio for this stage of your career might be 60% stocks and 40% bonds, again with a main focus on ETFs. If you are more of a risk taker, you can take some of that allocation and invest in individual stocks here as well, but you want to start pulling that percentage down a little bit. 10% invested into individual stocks at most would be a reasonable percentage. And remember, this comes out of your 60% stock allocation. And the final stage is known as near retirement, and it is through your late 50s into your 60s. But it can also be seen as anywhere from 10 to 15 years away from your retirement. At this stage, you should be shifting your focus to capital preservation as well as income generation. You have at most one normal market cycle left before retirement, so any dramatic loss of capital would be devastating at this stage. Also, while income generation through dividends is important at any age, at this stage in particular, a greater emphasis on fixed income investments like bonds should be taken. A typical allocation here might be 40% stocks with 60% bonds. And as you approach retirement, those 40% in stocks should be gradually phased into bonds. Okay, so those are good quality guidelines for the average person during the average year. Here's the thing. 2023 is not the average year, and as such, we have an opportunity to potentially lower our risk without really lowering our rewards. And remember, risk and reward are usually inversely correlated, which means anytime that we can lower our risk without lowering our reward, we should. The only time we shouldn't is when keeping our risk the same increases our reward. But in this instance, that does not seem to be the case. So we should lower our risk when possible. Okay, so how do we do that? Well, right now, interest rates are higher than usual. This is mostly due to the fight against inflation. If interest rates were high, but inflation was not, then this wouldn't apply. Because in that scenario, theoretically, stocks would also be performing better. But they are not. which means that there is a good chance that government bonds and HISAs will either outperform or at least close the gap to a lower than usual level between themselves and stocks. So what does this mean? Well, government bonds and of course high yield savings accounts both have lower risk than stocks. They both have near zero risk of default. So that means when we structure a portfolio, usually we are presuming that stocks will return somewhere around 10% and bonds will return usually around 3 to 4%. And savings accounts usually return 0 to 1%. So what happens if stocks seem like they will return less than 10% and bonds look like they could generate more than 3 or 4% and savings accounts are way higher than usual, closer to 4% return? Well, then we need to reevaluate how we are structuring our portfolios this year. And I'm just going to give it to you straight. You should consider increasing your bond allocation at every age and at every career stage that we just talked about. Not only that, you should seriously consider moving any non-invested cash into an FDIC insured high-yield savings account. Because if you don't, you are literally leaving virtually risk-free money on the table. Now hold on. The idea or thought that bonds may outperform stocks is one, a theory that may not happen. So please consult your financial advisor. And two, it is based on the presumption that we are getting close to the end of high inflation. This could absolutely be the case, but if inflation is stickier than we expected, we could be in for years of rate hikes. And in that case, the entire logic behind this goes out the window. So while I do think that there is an opportunity here, I also think that you need to consult your advisor and understand what you are doing financially before you make any major changes to your portfolio. Now, when it comes to knowing what you're doing, well, that's the entire goal of our series of 100 Days of Finance. I'm going to continue covering personal finance topics that will help you become a smarter human and a better investor. So feel free to subscribe if you haven't already so you don't miss all of those videos. And on Monday's video, we will be covering what dividend investing is and how you can use it to start generating passive income. So make sure to turn on the bell notification as well so you don't miss that video. And again, my name is Derek and I got my degree in finance so you don't have to. I love this stuff. It's been my passion for over a decade and I love to be able to share that with you guys. Have an awesome weekend, and I will see you in Monday's video.